open the question and answer to the floor. You could just kindly raise your hand, some will come to you.
I have a question here. I observed that most of the investment by India are halal investment. But my question is, all the financial organizations in Malaysia mostly go on Sharia compliance. Until now, EPF still is non-Sharia compliant. When is the plan that EPF going to be a Sharia compliant financial sector for this EPF fund? This is my question.
Thank you for the question. I think if you look at the EPF, we are non-Sharia compliant. I think we've always been very transparent about that. And the reason for that essentially is that we operate as a single fund. We don't operate multiple funds. That may change in the future, and we're looking at some possibilities there. But at the moment, essentially, the way we view our investments is that it is driven by ethical considerations, some of which overlap with Sharia. So, for instance, we do not invest in alcohol, we don't invest in gambling, we don't invest in weapons manufacturers, but we do not actively filter purely on Sharia grounds. We do have specific Sharia mandates in, for instance, fixed income or in equities, but those, by and large, essentially operate within the larger scheme of the fund. So the fund itself is non-Sharia in nature. And on the property front, again, we follow the same principles. We have not been acquiring assets which are leased to banks, primarily because, more because of our view on where financial consolidation is happening in Europe or in the UK, rather than because of on Sharia grounds. So we have properties that are leased out to people like the hedge funds, fund managers, on a smaller basis. On the logistics and warehousing side, we have warehouses with people like Sainsbury's or Tesco's, right? I fully expect that they stock alcohol in those warehouses. So I'm pretty sure that those warehouses may or may not be Sharia compliant from point of view. But from the EPF point of view, I think basically we look at returns, we look at our risk adjusted return, and we look basically at whether or not essentially it fulfills those criteria more than anything else.
Datuk, the reason why I'm suggesting to be Sharia compliant that when you declare the dividend, we Muslims, the dividend we cannot spend. We only can do rich and with some other things that is not relevant to the official spending of a Muslim. That's the reason why I'm suggesting that if you get a fatwa from the Majlis Ulama to declare it is Sharia compliant, and it is better for the Muslim not to declare in the EPF. This is my suggestion. Thank you.
Yeah. I think technically it's not quite possible for MB to declare EPF as Sharia compliant because we are not. I don't think we want to go down that route. But essentially, I think there is a fatwa or opinion that essentially that the dividend of your savings with EPF, once you reach the age that you can withdraw, you can actually withdraw, and if you want to, you can do zakat again at that point in time. But essentially, the fund itself operates on a non-Sharia principle, but essentially there is an opinion already out by the National Power Council that you can pay zakat on your savings with us once you actually withdraw at age of 55.
Thank you for that. Any more questions from the floor? Yes. Just 1 second, please. Yeah.
During the investment in Japan, do you have any criteria or sectors to focus on? Do you have any obstacle or upward to invest in Japan?
We've actually been already doing a fair amount of work looking at Japan. In fact, we had already thought about doing our first rollout assets last year. But then, there was changes in terms of government policy in relation to macroeconomic policy, which we felt would affect the Japanese yen. So we held back essentially on investment until we had more clarity about where the yen was going to go in terms of the exchange rate and what effect it would have on, for instance, on long-term interest rate trends. I think we're at this point now more comfortable to look at the market in terms of where we would like to be. In terms of the deployment plan, it will be very similar to what we've been doing in the other markets. So essentially start by building a core portfolio, probably of hopefully some commercial and some industrial logistics exposure, and then move on from there to look at other more interesting opportunities. We've always believed that we'd rather build a core portfolio first as a base, and then add on basically core plus or opportunistic assets. Having said that, of course, we've already been having some discussions with a fair number of property owners and financial people in Japan. Some of the limitations obviously is the fact that a lot of the really nice buildings, for instance in Tokyo, are already like well owned, sewn up by a lot of the big Japanese houses. Very difficult to get spaces in that space. And the other thing we're looking as well is whether we actually want to create a partnership in Japan, in the same way that we put a partnership in Australia and in Europe to basically help us better manage our risk profile. So yes, those are the areas we're looking at, but we'll probably still quite a few months away from an active deployment of assets. So that's why we've tended to gravitate towards UK, Europe, Australia, Singapore, the US, Japan, primarily because those are countries where we take a lot of comfort from the infrastructure, the legal infrastructure that's in place. For instance, I'll give an example. When we started deploying assets in the UK, of course it was very difficult for us, but we're now at a stage whereby we can essentially do a deal in the UK within a month. And a lot of times in the UK, you transact, you sign an SMP, you close in terms of completion within a week, which is a far cry from even Malaysia. One of the things I've always brought up to the government here is that it's easier for the EPF to buy a £300 million asset in London than it is for me to sell my condo in Classic Club. It's just possible here in Malaysia. We do a lot of this in Malaysia, right? But I think from our experience, end to end, for us to complete a deal in Malaysia can take anywhere up to 6 months. So there's a huge inefficiency for something like EPF, where we have to invest the assets because we have a constant flow of cash coming in. So that's why we like countries like I said, which gives us a certainty that we can complete a deal within a certain time frame and we can acquire assets and start earning money very, very quickly. In Malaysia, you see this with deals. Some of those deals take months. Not so much on the agreement front. Agreement front is very straightforward. It's about the same in all markets. But once you sign the agreement, right, not only completion, in terms of approvals, in terms of everything else we need to do, can take a long while. So that drives part of the situation that we do in terms of why those markets and why we do those markets.
Any more questions?
Despite the overview of what you just said, managed to 6.5%, is this sustainable? As well as especially that foreign investments are generating higher returns compared to domestic investments?
It's a fair question. I think one thing you need to realize about the EPF. The EPF is a realized return fund. We only ever declare a dividend out of realized income. We do not declare profits out of unrealized gains. So if you look at the balance sheet of the EPF, we are sitting on roughly about 50 billion ringgit of unrealized returns. These represent basically changes or increases in value in our equities, our properties, our fixed income. But none of that goes through to the P&L. But we are extremely conservative. If there is a fall in value, so for instance, if we have an investment which has dropped in value, we actually take the loss, the unrealized loss through the P&L. So if you look at the EPF balance sheet, it's always very clean. We normally see very little unrealized loss. It's all unrealized gains. Unrealized losses go through the P&L. And because of that, essentially, the dividend that we declare on realized income is purely from income generated, yields that we receive from fixed income, rents that we receive from properties, and trading income. When we actually buy and sell on markets, we realize the profit. That's part of realized income. So last year, a large chunk of the profits that was generated by EPF, we made about 35 billion ringgit last year in gross income. 50% of that was on the equity side. And we took advantage of a lot of liquidity in equity markets globally, both in Malaysia as well as in global markets, to churn the portfolio and realize income. So roughly about half of our equity profits come from trading. The other half is dividend. Obviously, hold large positions of blue chip stocks globally, and this provides listing revenues to us. So for the ETF, the main limiting factor in terms of generating returns, especially on the equity side, is actually liquidity more than anything else. Because we tend to invest in long-term and very strong companies. When you look at the split between our global assets and domestic assets, roughly about 25% of our profits last year were generated from our global assets. We have about 20% of the assets generated in invested in global assets. So if you look at it from a ratio point of view, yes, it performs slightly slightly better than domestic in terms of profit generation. But the key reason why we invest globally is because of diversification. The EPF is always concerned about an asymmetrical volatility in the markets. So for instance, we don't want to be caught out if, for instance, just what's been happening. There's a big slowdown in emerging markets which affects Malaysia. We want to make sure we have assets in developed markets that can generate returns for us. And that's really, I think, worked out very well for us last year, especially in the last quarter when there was a lot of slowdown in emerging markets. We made a lot of money in developed markets. And that's basically the strategy. We have to make sure that diversification works for us, so that at any one point in time, we have something that can make money for us. So even if there's a slowdown in industrials against oil and gas, we can have a position where we essentially can generate returns for our contributors. The only problem, of course, is that if there's a global slowdown, as what happened in 2008, 2009, then I think we will be affected just like everybody else. In those situations, it's going to be very difficult to generate a return that's sustainable. But from an EPS point of view, we view it as long term. As long as we can keep a sustainable return, and our long-term target is always being inflation plus 2% over an average 3-year period, then I think we are happy with what we have today.
One more last question from the floor, please.
Good morning to everyone. Carlos Ferrari, Italian Trade Agency. I have a question for you because it's very important for me, because I will be one of the speakers later, and one of the issues I will deal with is the return, immediate return versus the long-term appreciation of your assets. How would you rate the importance? What is more important, the immediate return on investment, or the long-term appreciation of your assets? How would you share these two elements? Thank you.
Every fund is slightly different. You have to understand the character of the fund as investing. For the EPF, like I said, because we are a defined contribution scheme with a focus on realized returns, we tend to place more emphasis on cash flow yields, right? Which is why we tend to prefer core assets, which generate a strong cash flow yield for us, and which has still some capital appreciation, but not as focused on appreciation. So if you look at the way we construct our property portfolios, 80+% are in core assets, a very small percentage in things like land or opportunistic where you're looking at capital appreciation. Right? If we were a defined benefit scheme, which is slightly different, and you're trying to close a asset liability gap over a long-term period, then you'll probably be more focused on this capital appreciation. Right? So funds like maybe CalPERS or funds like Co-op in Malaysia, right, will probably be more focused on trying to get assets with a higher probability of long-term capital appreciation as opposed to current yield. So that's really the big difference. So for us, really the focus is on yield versus more yield versus accumulation. We of course focus on accumulation as part of our portfolio, but in terms of asset allocation to things like private equity or long-term capital appreciation assets, very small compared to yield-based